Welcome to The Explainer. Today, we're diving into a really urgent and honestly, totally fascinating topic that's got the entire financial world buzzing. And yeah, maybe a little on edge. If you've been watching the markets lately, you already know Alibaba's stock just suddenly dropped 5%. And look, this wasn't some slow, gradual bleed, right? It was a sharp, aggressive move that caught a lot of people completely off guard, literally wiping out a massive chunk of market cap in just a matter of hours. So we're going to break down exactly what's happening behind the scenes. We're sticking strictly to the hard data to figure out the mechanics of this massive shift, why it's happening right this second, and most importantly, what it actually means for the future. Which brings us to the big question on everyone's mind right now, Baba stock. Do we buy the panic or do we run for the hills? With all these terrifying headlines flashing across our screens and our portfolios flashing red, it's so easy to just have that knee-jerk reaction. Fear is a powerful thing, But as focused learners, we've got to take a step back and ask, is this a rare, golden buying opportunity hiding behind some temporary market chaos? Or are we looking at the start of a much deeper structural problem for the company? To figure that out, we need a solid plan. So here's our structured, data-driven agenda for managing this headline risk over the next 90 days. 1. The panic. 3. Scary headlines. 2. Decoding the bad news. 3. What the market missed. 4. Scenarios, risk versus reward. 5. Key technical levels. And 6. The bottom line. Section 1. The panic. 3 scary headlines. Okay, let's validate that anxiety for a second because, wow, these 3 headlines are objectively terrifying when you first read them. First, a massive $10.2 billion AI share sale. Naturally, when a company issues new shares, we immediately worry about our slice of the pie shrinking. Then, Michael Burry liquidates his entire stake in the company. I mean, when the guy who famously called the 2008 housing crash heads for the exits, retail investors rightfully start sweating. His moves carrying massive psychological weight. People just assume he sees a total systemic collapse coming. And third, Alibaba's slashing their buybacks by a staggering 80%. When these 3 massive updates all hit the market at the exact same time, it basically created this perfect storm of uncertainty. And boom, that's what caused that immediate 5% drop. Section 2. Decoding the bad news. All right, let's dive into this and look at that $10.2 billion share sale first. See, this actually isn't immediate equity dilution. It's a convertible note. That means it's a bond that pays interest right now, but converts into actual shares later down the road. But here's the crucial catch. It was priced at a 14% discount to the current stock price. In the financial world, that tells us point blank that institutional buyers demanded a deal to take on this risk. They absolutely needed a buffer. And Alibaba? Well, they were so determined to quickly fund their new AI initiatives that they just agreed to it. They essentially took a short-term hit on the terms to get a massive cash injection right now. Next up, that scary Michael Burry headline. Sure, seeing a famous macro-level investor dump his position is totally nerve-wracking, but the real key to this story boils down to one simple number: 33%. You have to remember, Burry is fundamentally a deep value trader. He's not exactly a buy and hold forever guy like Warren Buffett. Burry bought his Alibaba position at $75 and sold it right near $100. Over just 6 months, he locked in a massive 33% gain. So the absolute crucial point here is that he didn't panic and run because the sky was falling. He just executed his strategy and took a massive profit off the table. It was a trade, guys, not some fundamental death sentence for the company's long-term survival. Then we have the 80% buyback cut. Honestly, from a purely mechanical standpoint, this is probably the most worrying news of the bunch. Before this, Alibaba was buying back $20 billion a year of their own stock. And when a company does that, it acts like a giant support floor. It artificially props up the share price because, well, you've got a guaranteed deep-pocketed buyers stepping into the market every single day. But now, they're purposefully yanking that safety net away. They are taking that immense cash flow away from financial engineering and funneling it directly into AI development. They are going all in. It's a hugely aggressive bet on the future of tech. Section 3. What the market missed. Here's what everyone's completely overlooking. Once you strip away all that panic, you uncover this absolutely staggering valuation gap. Consider the forward price-to-earnings ratios for a second. Even after this recent drop, Alibaba is trading at just 9 times forward earnings. Compare that to the US tech giants. Microsoft is sitting all the way up at 30 times, and Amazon is trading at 35 times. This shocking gap means one of 2 things has to be true. Either the market has just decided that Chinese tech is going to be valued at a permanent, massive discount forever, regardless of how much cash they print, Or there's a huge upcoming re-rating for Alibaba once the dust finally settles. And for your wallet, a re-rating means a sudden, aggressive upward surge in the share price to bring its valuation back in line with its global peers. Plus, there is some massive hidden upside here that the broader market is just totally ignoring in its rush to sell. Number one, Alibaba Cloud grew 13% last quarter. That's a highly profitable, incredibly sticky business. Number two, their AI-related revenue actually tripled. They're actively funding the future right now instead of just artificially pumping their stock price with buybacks. The pivot is already putting real cash on the table. And number three, remember those convertible notes we talked about? They actually have a 5-year maturity. That means the dilution doesn't just hit us tomorrow. If Alibaba's huge AI bet pays off over the next few years, those notes are going to convert at a much higher underlying share price, meaning current shareholders still stand to win back. Section 4. Scenarios, risk versus reward. So here is exactly how the risk versus reward breaks down, which gives us a pretty clear roadmap going forward. We've got 3 scenarios to look at. The bear case, which we're giving a 25% probability, takes us down to the $70 to $75 range. This happens if the expensive AI pivot just completely fails, or if geopolitical tensions flare up and delisting fears come rushing back. Then there's the bull case, also sitting at a 25% probability, which sees the stock absolutely flying to between $120 and $140. But this requires their AI to monetize beautifully, paired with a heavy macroeconomic stimulus package coming out of China. But I want you to focus on the base case right in the middle. We're slapping a 50% probability on this one, projecting a price target of $90 to $105. In this highly likely scenario, we expect a sort of sideways chop for about 4 to 8 weeks. The market just needs some time to digest that convertible offering. Once that financial indigestion clears up, we'd expect a pre-earnings grind higher as cloud growth hits 15% and those buybacks slowly start to resume. Okay, so how do you actually trade all this data? Well, here is the step-by-step scaling playbook for new buyers who want to manage this headline risk efficiently. Step 1, open a 25% position right now. This gets you some exposure just in case the stock rebounds way faster than expected. Step 2, add another 25% if the price drops to $80. That lowers your average cost during all this expected volatility. And step 3, invest the remainder only after we get solid fundamental confirmation from the next earnings report. Now, what if you're an existing holder who's already stuck holding shares near the bottom of this trading range? The data suggests you really shouldn't panic sell here. The worst of the news is already out there. But you also shouldn't just blindly double down either. Wait until we actually see the trading volume stabilize to prove that the bottom is truly in. Section 5. Key technical levels. We're going to get highly technical for just 60 seconds here to pinpoint some precise market entries. The first number you absolutely need to burn into your memory is the $82 to $85 range. This is the crucial pre-sale consolidation zone. In plain English, this is exactly where the stock spent a lot of time trading before all this recent news broke, making it our key support level right now. You really want to watch this zone closely, because if the stock breaks and holds below $82, the floor totally falls out. The next technical stop on the way down directly targets Michael Burry's old entry point at $75. Now, on the upside, the big number to watch is $100. This is the ultimate psychological resistance level. Not only is it a nice, round number that human traders just naturally fixate on, but it is exactly where that massive convertible bond was priced relative to. If the stock can actually manage to break cleanly above $100, that would be a massive signal of strength. It would tell us the market has fully digested the new debt and is officially ready to move higher. So, to know exactly when the worst of this crazy volatility is over, here are the 2 specific indicators you need to track. First, watch for 3 consecutive days of declining sell volume. When volume starts dropping on red days, it's basically telling us that the forced panic sellers are finally exhausted. The weak hands are officially out. Second, keep a close eye on the Relative Strength Index, or RSI. Right now, it's sitting at 38. Oversold territory officially begins at 30, so we are getting incredibly close to being mathematically oversold, which, by the way, often precedes a nice bounce, but we just aren't quite there yet. Section 6, the bottom line. Look, it all comes down to this. Alibaba is making a deliberate, painful pivot from buyback-fueled stock support directly to AI-fueled growth. The core underlying company, it's not broken. They are simply executing a long-term, highly positive maneuver to make absolutely sure they capture a massive piece of the AI revolution. However, because they are stripping away their buyback safety net to fund this future, it comes with very real, very sharp, short-term pain for investors. It's just the classic growing pain of a massive tech transition. So who is this setup actually for? Well, let's look at the buyers first.
This is specifically for long-term investors with a solid 2 to 3 year time horizon. You've got to be completely prepared to stomach potentially 10 to 15% more downside while this transition plays out. But if you have the patience, that valuation gap is just incredibly enticing. Conversely, who should wait? Honestly, anyone who needs liquidity in the next 6 months should absolutely stay away. We are expecting some remarkably high volatility as the market digests the conversion pricing details and waits on the upcoming cloud numbers.
Which leaves us with one final thought. Based on the hard data we just went through, this massive AI pivot, and those incredibly cheap valuation ratios compared to the US tech giants, where do you stand? Seriously, look critically at your own portfolio strategy and your risk tolerance. Are you stepping in to buy the fear? Are you selling the uncertainty to protect your capital? Or are you just going to sit back and watch the data unfold from the sidelines? Think about how these mechanics fit your own timeline. As always, keep learning. Thanks for joining me on this explainer, and I'll catch you on the next one.